Welcome to the deep dive. You know when the economic waters get a little choppy, like they can feel sometimes? I think a lot of us start looking for investment strategies that feel a bit more predictable.
Definitely. And dividend stocks often come up in that conversation, don't they?
Exactly. So today we're going to zero in on three specific companies. The Motley Fool highlighted these as brilliant long-term dividend buys. And they specifically mentioned sticking with industry leaders during uncertain times seems like a good approach.
Right. So our kind of mission today is to really get under the hood, understand why these three Realty Income, Prologis, and AvalonBay are seen as such strong picks for the long haul, especially if you're looking for reliable income. We'll unpack their businesses.
Okay, sounds good. Let's dive right into the first one then. It's got a pretty memorable nickname, Realty Income.
Ah, yes, Realty Income, ticker O on the NYSE. They've actually trademarked the Monthly Dividend Company.
Really?
Yeah, that tells you a lot, right? Their whole focus is that consistent monthly payout. And what's really quite remarkable is their track record. They've increased that dividend every single year for the last 30 years.
Wow, 30 years straight. That's impressive. That kind of consistency, it doesn't just happen, does it?
No, absolutely not. It's built on a solid foundation. They have an investment-grade rated balance sheet, which provides a lot of stability.
So what's the core business model driving that reliability?
Well, a huge factor is that they're the largest net lease REIT. Now, what net lease means, essentially, is that their tenants are responsible for most of the property-level operating costs.
Okay, so things like maintenance, insurance, property taxes.
Exactly. Those sorts of things. This insulates Realty Income quite a bit from, unexpected jumps in operating expenses at the properties. It makes their cash flow much more predictable. It's generally seen as a lower risk approach within REITs.
Right, so they own the buildings, but the day-to-day upkeep costs mostly fall on the renters.
Yeah.
Makes sense. How big is their portfolio? You said they're the largest?
Oh, it's vast. Over 15,600 properties.
15,600.
Yep. Across the U.S. and also in Europe. And while about 75% of their rent comes from retail properties, it's not typically enclosed malls. Think more standalone locations, often with strong tenants, easier to buy, sell, release, that sort of thing.
Okay, more flexible. And the other 25%?
That's diversified. Some industrial properties, even some gaming properties like casinos. It adds another layer, to their income streams.
And the key number for income investors, especially now. What's the dividend yield looking like?
At the time the source was written, it was yielding around 5.5%.
5.5%. Yeah, that's definitely an attractive figure in the current market, especially coming from a company with that kind of track record.
Absolutely. Given the history and the business model, it's quite compelling.
Okay, great. Let's shift gears now to this second pick, Prologis. This takes us into a different area. Warehouses, logistics, also pretty essential, I'd say.
Extremely essential. Prologis, ticker PLD. They are the heavyweight champion of warehouse REITs, basically. Huge global footprint, very strategically located properties near major transportation hubs, ports, airports, highway interchanges.
Right. Now, the source mentioned the stock had taken a bit of a hit, down from its recent highs. Something about tariff concerns.
That's right. When the article came out, the stock was down maybe 20% or so from its 52-week high. And yeah, worries about global trade, tariffs, how that might impact things, that definitely played a role.
So some potential headwinds there. Might make some investors nervous.
It could in the short term, but the way the Fool frames it, and I think it's a sound perspective for long-term investors, is that this dip actually creates an opportunity. It pushed the dividend yield up to around 3.9%.
Okay, 3.9%.
Which for Prologis is actually near the highest level it's been in about a decade. So, a better entry point potentially.
So turning a short-term concern into a potential long-term buying opportunity yield-wise.
Precisely. And let's not forget Prologis' own dividend history. They've increased it annually for the last 12 years, so there's a growth trend there too.
12 years, okay.
And the core thinking is this. International trade isn't just going to stop, right? It might shift, routes might change, supply chains might reconfigure, but the need for well-located modern warehouse space isn't going away, if anything, with e-commerce and supply chain resilience being such big themes.
The demand probably stays strong or even grows, just maybe in slightly different patterns.
Exactly. So the long-term argument for Prologis seems pretty solid, even with some short-term noise around trade dynamics. It's sort of a buy-the-dip idea for a quality leader.
that makes sense. Global commerce adapts, but the need for that core infrastructure remains.
Okay, let's look at the third and final pick. AvalonBay, ticker AVB. This one's in the apartment space.
Correct. AvalonBay, the largest apartment REIT measured by market cap. Their dividend yield is currently around 3.4%. Okay, 3.4%. That's noticeably lower than Realty Income's 5.5%.
It is, and the article points that out. It's actually pretty typical for top-tier apartment REITs. They often trade at a premium valuation compared to some other REIT sectors.
Why is that, generally?
Well, two main reasons are highlighted for liking AvalonBay. First, the fundamental nature of the business. Housing is essential. People always need a place to live, which provides a certain baseline stability, even in tough economic times.
That's right. Shelter is pretty non-negotiable.
Exactly. And second, AvalonBay has a really long, proven history of managing its portfolio effectively. They're known for being quite strategic, buying, selling, developing properties based on where they see the best opportunities and market conditions. They adapt.
And the source mentioned a specific strategy they're pursuing now.
Yes, they're currently focusing their development efforts building new apartment communities primarily in the Sun Belt region.
Follow the demographic shifts and job growth down there.
Precisely. It shows they're actively managing the portfolio to capture growth. Now, it's worth noting, they haven't increased their dividend every single year like Realty Income.
Okay.
But the overall trend of their dividend payout over decades has been consistently upward. It shows long-term growth and financial strength. So if you want the leader, the biggest player in the apartment REIT space, AvalonBay is generally considered the go-to name.
Got it. So a bit of a lower starting yield perhaps, but you're buying into that essential service aspect and a company with a strong reputation for management and adapting to market trends.
That sums it up well. Stability and proven management are key parts of the appeal there.
Okay, so stepping back and looking at all three, this deep dive into the Motley Fool suggestions really seems to reinforce that idea of, focusing on the established leaders in different REIT sectors. It seems like a potentially solid strategy for finding reliable dividend income, especially when things feel a bit uncertain out there.
I think that's the key takeaway. You've got Realty Income, the Monthly Dividend Company, strong track record, net lease model for consistent income. Then Prologis, tapping into the long term, enduring need for logistics and warehouses, even if trade patterns shift. A potential opportunity there given the recent price movement.
Right.
And finally, AvalonBay, the leader in apartments, playing on the essential need for housing with that history of smart management and adapting, like moving into the Sun Belt.
Yeah, three distinct angles on reliable income through real estate leaders. Some really good insights there. So as you, the listener, think about these three: Realty Income for that steady monthly check, Prologis for maybe riding those long-term global trade waves, and AvalonBay for its essential nature in management. Here's something to maybe chew on.
Okay.
Beyond these big players in real estate, what other sectors out there feel truly essential day in and day out? And could focusing on the leaders within those essential sectors offer similar kinds of stability and maybe even long-term dividend growth for your own investment strategy? Just some food for thought.